The United States Federal Open Market Committee announced last week that it would begin purchasing additional agency mortgage-backed securities at a pace of $40 billion per month and continue Operation Twist until the end of this year. It was announced that the federal funds rate would likely be kept at 0 to 0.25% at least through mid-2015. Tony Bell from Vunani Fund Managers joins us on the desk to discuss the implications for investors. And Tony, I think let's take that as our first question. In terms of the move by the Fed, what does it mean for us here in South Africa, and how can we capitalize on this information flow?
Hi, good afternoon or good evening. Essentially the move as we see it is that we are in a bit of a honeymoon period. The European Central Bank has firmly stepped on the gas pedal and the Fed has followed suit. I think what's important from our perspective, and certainly for the viewers out there, is we see quite a big difference between the investment decisions that one needs to make in one's portfolio and the impact of these very significant liquidity surges into the financial markets for different purposes. In short, the Fed is essentially stepping on the gas pedal to try and get the banks to lend again, whereas the ECB's focus is a lot more on securing the stability in the financial system, and they each have different implications. The long-term consequence of the Fed's action may be inflation. It's not inflationary at this stage. We still see the biggest pulse coming through from the lack of consumer demand and the capacity that exists in that economy, and that capacity will need to be taken up before we start to see the inflationary pulse coming through. But ultimately, Mr. Bernanke or Dr. Bernanke is going to have to deal with higher inflation in months and years to come, whereas the ECB is still sitting with a significant problem of lack of final demand because of the plight of the southern European countries.
Hi, Tony. Just to ask you, I mean, this question about the unemployment in the United States is the big one, and everyone's, or many analysts are saying that things will only really meaningfully improve in terms of the economic growth there when the unemployment rate improves. Currently it's at about 8%. Warren Buffett made the comment that it will take a resurgence or a proper recovery in the housing market to get people employed because of the labor-intensive nature of the housing market. What are some of the things that you would look at to see whether or not the economy is improving in the States, and that would ultimately feed over into other markets?
Yeah, it's a really nice question, and I think what's important is that the Fed really has taken over the role that government would normally play in this sort of environment. The well-known economist Keynes must be feeling a little anguished right now because in a downturn as severe as this, it normally is government that takes over and introduces some fiscal spending into the economy to keep the economy going. We're seeing tentative moves in that regard in China at the moment, but because the US government has borrowed so much, it literally is unable to spend. The Fed, in taking over part of the role to try and stimulate the economy, has a much more difficult task because the transmission mechanism of all this money into the economy is tangential at best. What they're trying to do is get the banks to lend again so that consumers can spend, so that companies can invest, and in that process create jobs. I think we're going to be with a fairly flat housing market for some time, so the structural nature of jobs in the US, if we look back in 2 years' time, is going to be very different from what it would have been if government had had the capacity to spend.
So does that mean you're still bearish on the state of the economy and the recovery in the United States?
Warren, I think we're going to face a challenging 2013. I think it's important to separate the stimulus from the actual economic activity that we're seeing. The States is not as badly off as Southern Europe, but we do concern ourselves with the fact that in order for the economy to gain traction, it really is going to have to come both in the States and Europe from broader-based policies that look to stimulate growth. The ECB and the Fed are trying very hard to get that going, but in the absence of government spending in both Europe and the States, the trajectory of growth is going to be very slow and very low.
Tony, I want to bring us now to your current asset allocation. You remain overweight equities. Can you give us a little more color on that position?
Sure. What we've recognized in terms of the way we manage both our equity portfolios and our target return portfolios is when you do have a big liquidity pulse, as we saw in QE1, less so in QE2, which was then referred to as Operation Twist, and now QE3, you do have risk assets responding quite favorably, primarily because the dollar weakens, commodity prices move higher, and risk assets are suddenly more attractive versus the more defensive cash-oriented investments. The process of asset allocation from a tactical point of view, we've taken advantage of that, but we're very aware that the liquidity pulse can be transitory, and it's not a really solid foundation on which to base long-term investment decisions, because we really are moving in a world where policy changes can materially influence the risk premium of markets and how investors respond. And that's why we've lived with all this volatility for the last 2 years. So in the portfolios themselves, we're overweight equities. We prefer inflation-linked bonds in South Africa to nominal bonds. From a sector allocation perspective, we're underweight financials. We're underweight the consumer services sector quite materially. We're overweight resources, and we're overweight technology.
Okay, that was one of the interesting things we saw in your notes to us, is that you'd indicated you'd moved out of the defensives and into the cyclicals. One of the things I understand going on in the market is that many fund managers have been sitting out of the run that some of the retailers have been enjoying because they've been too expensive. Sure. Is this sector rotation, as you call it, from the defensives, like the likes of BAT and SAB Miller, now into some of the cyclicals, which include the resources and construction? Is it a prudent move for the long term from the point of view of the investor?
Warren, I think the answer to that is it depends on the nature of the investor's risk profile. I manage two types of funds. I manage a very conservative suite of funds where the bet size that we've taken in that regard is very small. And then I also have the pleasure of running a more active high-risk equity-only portfolio, and there the bet size is a lot bigger because we have the latitude to do so. An important caveat is that we're constantly monitoring the position, so for me the investment horizon is really a matter of weeks and months as opposed to years. I think to properly answer your question from a long-term investor's point of view, you've got to stick with companies that have the ability to accrue value to the shareholders, mostly through good return versus cost of capital margins, companies that generate strong cash flow. And if you really were to ask the question, could I put the stock in my portfolio for the next 3 to 5 years and not worry about it? Resources are not going to be in that category.
Well, Sasol is your top holding. Tony, what really excites you, along with all the other fund managers in South Africa out there, about this story? It was a subtle dig.
It's certainly my top holding in terms of nominal weight, but not active exposure. My biggest active exposure, in fact, is a small technology company called Pinnacle, where I've got about a 4.5% exposure over and above the SWIX weighting. From a nominal position, in other words, the biggest percentage stock holding that I've got is Sasol. Sasol really has moved quite aggressively into a contentious area, shale gas in Canada and in America. And if you have a look at the future of energy and the differential between the natural gas price and the oil price, with the right technology and with Sasol's proven ability to convert liquid gas to fuel, it is a pretty exciting opportunity longer term. The South African operations are largely mature and we don't see too much excitement there.
So Tony, I mean, just in terms of Sasol, is it a defensive company or a growth company? Because I think it has both. We obviously know it's a rand hedge. How do you sort of think about Sasol in your portfolio?
Well, a little bit of all three. We see a very stable domestic operation that has a good underpin to product and price. We like the fact that it's got a nice rand hedge component given the slightly parlous state of our current account and the potential that even though we're going to go into a weaker dollar environment, the rand certainly structurally is starting to look a little weaker rather than stronger. And we've got a little bit of a twinkle in Sasol in the form of the blue sky potential given their investments in offshore interests such as the shale gas operation. So it's a nice combination between the prospect of good returns if that side of the business accrues good profits and the stable returns from domestic businesses.
In terms of the technology companies, Tony, you've indicated that you like Pinnacle. Pinnacle Technologies is one of your favorite holdings, but you've also been increasing your exposure to data tech. Could you just tell
Correct.
us your thinking around the current state of the IT companies, where we are fairly limited in terms of the number, but why you in particular, why you like data tech?
Yeah. I think as a sort of a general response to you, what we see in those companies is we're seeing ever increasing need. If you look in the portfolio, you'll see I've got Data Tech, I've got EOH, and I've got Pinnacle. I like the combination of all three because you're not paying a particularly high multiple for the company in terms of free cash flow generating ability. The companies are enjoying particularly good margins, and as the broader economy tries to improve its efficiency, the combination of equipment, services and infrastructure starts to play quite nicely into what essentially is a very small group of companies servicing a growing market. Those companies are just starting to look at the push into Africa, and there's going to be quite a lot more demand for better IT infrastructure into Africa, into the cloud space, and the multiples are very, very attractive at this point.
Would you still be buying Pinnacle right now? How high is that level of conviction?
I do have a very high level of conviction on Pinnacle. I've held the stock since the early 9 rands. We meet with management very regularly. The recent results were particularly good. A little bit underplayed, I think, by virtue of the investment that they've made in their business. There is a lot of receivables on the balance sheet that talk to the investment of the company and their working capital and their desire to expand. So even at current levels, according to my calculations, you're getting the next, you're paying a multiple of virtually 1 times for future cash flow generating ability compared to some of the retail stocks where, although we see them as very good companies, the multiple on future cash flow generating ability for something like SPAR is as high as 8. So I'm a lot more comfortable with a company where I'm not paying a premium for that company's ability to deliver future shareholder value.